The decline started quietly. A few companies moved their headquarters to Paris. Then IPOs dried up. Now the City of London, the financial engine that powers the entire United Kingdom, is stalling. But this isn't just about bankers losing bonuses. It's about a dangerous gamble the British government made decades ago. They bet the entire nation's future on 1 square mile of real estate, assuming the money would always flow. They were wrong. And now that the engine is failing, the rest of the country is about to pay the price. To understand why this collapse is so dangerous, you have to look at how the UK is actually built. For the last 40 years, successive governments didn't just favor London, they actively engineered the economy around it. The strategy was explicit. Policymakers believed in agglomeration, the idea that clustering all the money, talent, and infrastructure in one place would create a super economy that lifted everyone else up. So they poured resources into the capital. Between 2010 and 2020, London's share of total real estate capital value in the United Kingdom jumped from 34% to 42%. While the capital got world-class transport and digital infrastructure, the north of England was left running on outdated systems. The disparity became staggering. Today, the median household wealth in the southeast is over £503,000. In the north, it's less than half that. Even worse, the richest 10% of households now hold 43% of all wealth, while the bottom half of the population fights over just 9%. The government's logic was simple. London would generate the tax revenue, and that money would fund public services in Liverpool, Manchester, and Newcastle. The financial sector in London alone contributes about 8.5% of the entire UK GDP. It's a massive cash cow. But this created a distinct vulnerability. The UK became a dual economy. You had London, a high productivity global superstar, and then you had the rest of the country, which often struggled with productivity levels lagging significantly behind. This wasn't an accident, it was a trade-off. The government effectively told manufacturing hubs in the North and the Midlands that their decline was acceptable because London would write the checks that could keep them afloat. Despite recent slogans about leveling up, the gap hasn't closed. They put all their eggs in one basket. The problem is, when you build an entire nation's stability on the performance of a single city's financial district, you leave yourself with zero margin for error. If that district takes a hit, there is no backup plan. There is no second engine. And right now, the single engine is sputtering. The regions outside London can't pick up the slack because they were starved of the investment needed to build resilience. So, when the City of London catches a cold, the rest of the UK doesn't just sneeze, it risks pneumonia. And as we're seeing now, the sickness is starting to set in. The mechanism that broke London's dominance wasn't a market crash or a banking scandal. It was a regulatory switch that got flipped the moment the UK left the European Union. For decades, the City of London operated on a system called passporting. This was the golden ticket. It allowed a bank based in London to sell services directly to a client in Berlin, Madrid, or Rome without needing a separate license in each country. It made London the default launchpad for any global bank wanting to do business in Europe. You set up shop in Canary Wharf and you had access to the entire continent. When Brexit happened, passporting ended. It was replaced by equivalence, a patchy, unreliable system where the EU decides if UK rules are good enough. The financial sector realized immediately that they couldn't build a long-term strategy on a political permission slip that could be revoked on a whim. They had to move, and they did. It wasn't the dramatic exodus of people that the doomsday forecast predicted. Early reports suggested 100,000 jobs would vanish overnight. That didn't happen. Instead, what we saw was a massive, silent migration of capital. According to the think tank New Financial, more than 440 banking and finance firms responded to Brexit by relocating part of their business, moving staff, or setting up new legal entities in the EU. In addition, banks transferred more than £900 billion in assets from the UK to the EU, roughly 10% of the entire UK banking system. Insurance firms and asset managers moved another £100 billion. We're talking about £1 trillion of capital that simply shifted jurisdiction. It didn't disappear, it just disappeared from the UK's ledger. This created what researchers call a multipolar financial world. Before, London was the undisputed center of the solar system of European finance. Now the gravity has dispersed. Dublin absorbed huge amounts of asset management activity. Paris became the new hub for trading operations. Bank of America, for example, set up its EU markets headquarters in Paris, moving hundreds of staff. They didn't abandon London entirely, but they stopped treating it as the center of the universe. The danger here isn't just about the assets that left, it's about the business that never arrived. This is the missing jobs phenomenon. While only about 7,000 roles were physically relocated, the growth has stopped. Employment in the financial sector has flatlined since the referendum. Global banks are still hiring, but they aren't hiring here. When a US bank wants to expand its European trading desk today, it hires that new trader in Paris or Frankfurt, not London. The UK hasn't just lost existing capacity, it has lost the future trajectory of the industry. The city is being hollowed out from the inside, not by a sudden collapse, but by 1,000 quiet decisions to invest somewhere else. This silent relocation hits the average worker too, not just the wealthy elite. When a financial institution expands in Paris, it doesn't just hire traders there. It hires IT technicians, legal assistants, and office managers too. The entire support ecosystem, from construction crews to local service businesses, moves with the growth. The missing jobs aren't just in high finance. They are the thousands of ordinary roles that support it, opportunities that are now being created across the channel instead of in the UK. This is where the government's gamble falls apart. Remember, the plan was for London's high productivity engine to generate the surplus wealth needed to support the rest of the country. But as the city stalls, that surplus is evaporating at the exact moment the rest of the UK needs it most. The transition mechanism here is tax revenue. A high-frequency trader in London earns a massive salary and pays a massive amount of tax. That money goes to the Treasury and gets redistributed to fund the National Health Service, build roads in Wales, and pay pensions in Yorkshire. When that trader's job moves to Paris, or more likely, when the next trader is hired in Paris instead of London, the UK Treasury gets nothing. The taxman in London doesn't get a cut of a salary paid in France. This leaves the government with a shrinking tax base to support regions that are already in crisis. And make no mistake, the situation in the north of England is critical. While the financial sector is struggling with regulatory barriers, the manufacturing hubs in the northeast and northwest are being hammered by the tangible reality of trade friction. These regions rely heavily on physical exports, cars, chemicals, food. Since leaving the EU, goods exports to the EU bloc fell by approximately 14%. Small businesses that used to trade freely with Europe have simply given up. The administrative burden of customs checks and new paperwork wiped out their margins. So you have a dual economy where both engines are failing simultaneously. The service engine in the south is losing its global access, and the manufacturing engine in the north is choked by red tape. The data reveals just how fragile the UK economy actually is without the city firing on all cylinders. Latest forecasts from the Office of Budget Responsibility suggest 2026 GDP growth of only about 1.4%. But we know the finance and related services, dominated by London finance, account for a meaningful share of UK output. If London finance falters or shrinks, and the rest of the economy continues to hover around sluggish growth, the effective growth rate for non-finance UK might drop well below headline numbers, perhaps toward the 0.5 to 0.8% range. That's not just weak growth. For many regions, that could feel like stagnation. This is a reckoning. The government spent 40 years neglecting regional productivity, assuming London would always be there to pay the bills. They let the North's infrastructure crumble and its skills base lag, masking the problem with fiscal transfers from the capital. Now the capital is struggling. The golden goose is sick, but the farm it was supporting was never built to be self-sufficient. There's no other high-growth sector ready to step in and fill the void. The buffer is gone. The regions that were promised leveling up are instead facing a future where the central government simply cannot afford to help them because the tax receipts they relied on are being collected by the French and Irish governments instead. There is a flicker of hope. Fintech clusters are emerging in Manchester and Leeds, already adding £5 billion annually to the northern economy. It proves innovation still exists outside London. But here is the brutal math. $5 billion is a rounding error compared to the £1 trillion of assets that just shifted to Europe. These green shoots are promising, but they cannot replace the massive amount of capital that left. the scale of the loss dwarfs the speed of recovery. The UK bet everything on London, and London lost its passport. Now, the bill for decades of regional neglect is coming due, and suddenly there is nobody left to pay it. If you want to learn more about another major country facing a significant economic challenge, click on the video on the screen entitled "Why One Simple Number Will Destroy Japan."